Let's also welcome Gurmeet Chadha, Managing Partner and Fund Manager at Complete Circle Consultants. And Gurmeet, very good afternoon and thank you so much for your time. First of all, Gurmeet, help us with your take on the markets at this juncture because it's been a decent sell-off from the high point. But any area where you are finding the valuations to be attractive or good opportunities at this price point? And also, Gurmeet, help us with your take specifically on the PSUs because they have been feeling the heat in quite a fashion now. And do you believe that the PSUs have some headroom for some recovery?
So, on markets, I think, Nuresh was right. In absolute terms, this is a lot of selling. I think nobody really anticipated this kind of selling coming through and in a matter of few weeks. So it's almost 12, $13 billion gone. And whenever you will have that kind of a selling, I think market has still, in my view, absorbed quite a bit of it. Uh, uh, I think so that the multiple reasons for it, started with China's stimulus. Then I think probably the world knows that there'll be some more escalation with Israel. Probably will launch a bigger attack on Iran. And also there is US elections in 2 weeks from now. And there could be some, cash and dry powder be peeled back. So multiple factors there. But, most of these factors, are there because the valuations are stressed in few pockets. And that's why the reaction you are seeing is a little more in pockets where earnings are weak. And that is why, so whenever there are good numbers, market is rewarding. Even slightly better numbers like Bajaj did post a slightly decent side. SGFC was a little decent. So market rewarded that. And any poor set of numbers, I think the stocks are getting hammered. I think it's going to stay like that. So the stance on recovery has to be where there is earning support because the markets are still not as cheap as that you can do basket buying. We like financials. We have been dipping into it. We have bought ICICI amongst large cap. We've added to SBI. In tier two banks, we've added Federal Bank. We are also looking at some good select NBFC, something like Uto Capital, which is into only MSME lending. They crossed 10,000 crore a year and they have done a fundraise and they trade below book. Good metrics. Then we are adding few defense names where we have seen a 20-30% correction from the peak. Adding some auto ancillary stocks, they've been under a lot of pressure. And even the OEMs, if you see from the peak, Tata Motors is down 25%, M&M is corrected 15-20%. So we are adding some of that. In PSUs, we are more gung as I said, on PSU banks. SBI trades at book. Bank of Baroda came up with a very good update. You will see treasury gains coming through this quarter. The 10-year bonds have softened. Also in Bank of Baroda, the retail mix is improving. The dependence on wholesale budgets, the overseas loan book, the stress points in the balance sheets are improving. So, and I think there is valuation cover. In fact, the entire bank Nifty probably could trade at about 14, 15 times versus let's say 21 times of Nifty. So I think that offers good risk reward from a medium term perspective.
Right, Gurmeet. I agree when you say that the valuations are stretched, but that is much more specific when it comes to the mid cap and the small cap space. When you look at the large cap specifically, even the Nifty's 12-month forward price to earnings, if you look at it, it's very much near to its 5-year average. And large cap is one space where valuations are not actually stretched. So why is it that we are still continue to see selling when it comes to the large cap space? Specifically, we can also see Reliance Industries for that matter. It has come down from 3,200 to now 2,700.
No, so largely whenever you see an ETF and passive selling, it doesn't look at the price. And Reliance is the largest weight of the index post SDFC. Almost both of them put together are 20%. So when we look at the consolidated earnings, yes, it looks reasonable at about 18, 19 times, but the growth of earnings, which now is coming, doesn't look to be in double digit unless you have banks really doing the heavy lifting. And currently, I think the template is looking like more high single digit EPS growth. Then even 18, 19 times looks a little stretch. But as I said, this is selling. And when you have basket selling, it doesn't apply logic on valuation. By the same logic, S&P 500 is 27 times earnings, 28 times earnings, and it's trading at a high. So I think flows in the near time might cloud your judgment. But I'm of the opinion that when large part of the correction is due to non-India reasons, some part of it is due to valuation, the bounce back also will be very, very quick. And that is why it is important to dip into places where you see near visibility of earnings. Secondly, I think the corporate balance sheets are deleveraged. Our macro is pretty good. And despite all this, we technically not seen a 10% correction for a very long time. I think despite all this, YTD Nifty is up 12-13%. 1 year return is still 18-20%. So I think some corrections are normal. It's just that we haven't seen some, and that's why this is looking a little more unnerving. Every correction is unnerving, but this one is because it's happened very sharply. It's looking a little more unnerving.
Well, flashing onto your screen is the SBI Life numbers. The net profit has come in at close to 530 crore rupees. The street estimates were close to 730, and the net premium income number is close to 20,270 odd crore rupees. The stock has declined from its day's high. So need to keep an eye out for this number. We'll get in more details for that. Till then, let's slip into a short break.
Well, as far as the market mood is concerned right now, let's take a look at whether we are holding on to gains or whether we have given up. We have given up. There was some profit booking that happened at the higher level. So we are back around the 24,450 mark. In fact, headed towards the lowest point of the trading session. Let's take a look at the Bank Nifty as well. Is it holding out a bit better? While the gains were limited on Nifty Bank, at least the losses have been narrowed as well. So it's been a bit more range bound versus the Nifty, which has seen a bit of a drop. So Nifty Bank hasn't given up, but it was muted in any case to begin with. Mid cap and small cap indices will also come up for you on the screen. They were seeing a bit of an outperformance at the start of the trading session. They are holding up in the green, but of course of the highest points of the day. Quickly taking stock of some of the buzzers there. On the gaining side, you have a lot of names which are in focus right now, partly on account of earnings as well. So a Deepak Fertilizer will come up for you on the screen. Amber Enterprises, First Source, Coforge, Persistent System, all of these companies doing well, while KPIT is on the back foot. Remember, KPIT maintains its guidance for FY25. They are talking about 18 to 22% growth with an EBITDA margin of around 20.5% plus thereabouts. But the stock has taken a bit of a tumble because the commentary was weak. The management did highlight that mobility segment is going through pressure across the world. Dipan Mehta also joins us on the show right now. Dipan, this was one of the reasons of outperformance of a stock like KPIT for the last 2 to 3 years, that they were present in a very niche segment, and at that point of time, of course, this entire ADAS theme, EV transition was doing well. Now with headwinds coming in the mobility segment in Europe, do you expect a sharp reversal of sorts for the likes of KPIT, etc.?
Yeah, good afternoon, and thank you for having me on your show. Yeah, I think you have to temper expectations from KPIT, and it's trading at extremely rich valuations, and base effect also comes into play. And overall, I think that yes, I think this entire EV story, there seems to be some doubts which are rising over there. So I'd be a bit careful in KPIT. At least wouldn't back to make any fresh investments. But existing shareholders are sitting on a lot of profit, so maybe they can ride out this kind of rough volatility for some time. But on the whole, I think that, as I said earlier, that we need to be a bit careful in such stocks which are focused specifically on one particular vertical, and any kind of slowdown in that vertical can certainly impact the profitability.
Okay, point taken. So that's a view coming in on KPIT Tech. If you're making fresh investments, be a bit more cognizant of what's happening. What about fresh investments in Paytm now? Because a lot of people were saying that perhaps wait for the event to play out. Now we do have that NPCI approval coming in. Would you be a buyer now, or it's run up already, $750 a piece?
No, I think look at the screen over here. It's not looking good at all. And I would like to just reserve any form of buying for the next few weeks. I think we are reaching a tipping point over here. And in the next 3 or 4 trading sessions, if the market doesn't recover lost ground, then we may be in for a deeper correction. That is what it appears to me. Also, this earnings season is turning out to be a very big disappointment. And there are very few winners, but a whole host of large cap companies, mid cap companies have started to disappoint. So I can see the sentiment getting sour, at least in the short to medium term. So from that point of view, I'm going to be a bit careful and avoid any purchases at this point of time.
India's largest IPO listed on the stock exchanges yesterday. Multiple brokerages have come out with initiating notes on Hyundai. Nearly 6 of them, out of which 5 have a buy rating, while 1 has a reduced rating. And we have Shrishti joining us with all those details. Well, among the sell ratings, it's MK which has a sell rating, and among the buys, it's Nomura, Macquarie, Ambit, Damcap. Everyone has a buy rating, and the target price are more than 2000 plus. But the stock is still struggling when we see to cross even the IPO price of 1960.
Yeah, because there are Headwinds that people are worried about. For instance, I was reading that note from MK which has a reduced rating, and they are talking about how royalty is one of the challenges. There's going to be high, lower treasury income from here on. The capacity is something which is slow to ramp up. Plus the kind of launches that they have are much less than the peers, and that's why they had a bit of a worry around it. But I think we can take it across to Srishti to get more details on this one.
Well, certainly not a great listing for Hyundai Motors, which was the one of the biggest IPOs in the Indian markets. Just on the first day itself, we did see the stock tanking 8%, and for now there are a lot of these key concerns that these analysts are highlighting. First up is the increase in the royalty payment. They have been fearing that from 3.5% there could be some increase, but the management did come out with a commentary, but was not taken that very well, because the margin contraction in the while back was also seen to be done on the back of the higher royalty. Other than that, this particular IPO was a complete OFS. No fresh capital was coming into Hyundai Motors India, which was indeed not making this particular IPO that much attractive. And there's always a key talking point of Hyundai versus Kia conflict of interest, because Hyundai parent company does hold some stake in Kia Motors as well. So in the Indian markets where both these players are present with a good market share, there will be some conflict of interest in terms of their strategy as well as sales growth. Other than that, at the time when Hyundai Motors IPO did hit the markets, we were experiencing a slowdown in the passenger vehicle space, as well as overall there were some inventory issues. So all these factors did build in at the time when IPO did hit, and the IPO was not seen to be performing that very well and still trading below its issue price of 1960. While majority of the brokerages are having buy rating or a positive stance on Hyundai Motors IPO, but it's MK that has gone ahead and maintained its reduced rating with a target price of 1750 rupees. They are saying that there is high valuation amid muted growth outlook. There could be a lackluster 5% EPS CAGR over FY24 and 27. The lack of new major launches in the next 12 to 18 months are not giving that much of confidence, as well as some of the capacity expansion plans that the company wants to take its capacity output to 1.1 million units in the times ahead is way lesser than what these peers, especially Maruti Suzuki, is looking to almost doubling down its capacity by 2030, as well as if we talk about the high royalty and as low treasury income are likely to restrict the EPS growth. So on the back of all these factors, believe that they did weigh heavy on Hyundai Motors IPO. Back to you.
Well, thank you, Srishti, for giving us all those details. Dipen, how is the Hyundai listing looking, Hyundai stock looking to you? This is still down around 50 rupees from its IPO price of 1,960. The street seems to be quite bullish on the long-term prospects.
Fine, but as I said, overall market trends and what is happening in the auto industry also, we are seeing inventory pile up, increased discounting, and the kind of waiting lists which were there, they seem to have dissipated. Also, in terms of new model launches, entire industry and Hyundai also are going a bit slow. And a lot of new launches came through post-COVID, and that caused a lot of excitement and it generated a lot of volumes. But now that trend also seems to be, I would say, stagnating. So I would be a bit cautious in Hyundai as well. It's not that it's extremely attractively valued, it's reasonably valued compared to Maruti. And Maruti, mind you, has got a long listing history and a fabulous track record as well. So, paying a higher premium for Hyundai, one needs to think twice. So I would say that just wait and watch. I think entire auto industry, 2-3 quarters, you need to be a bit careful. Volumes may be under stress, as we have seen. Monthly sales figures have been a bit disappointing, and that will start to reflect in the top line, bottom line at the quarterly results time as well. So just wait and watch. Maybe you can see a further correction in Hyundai.
Likely, as far as Hyundai is concerned, so don't be in a hurry to buy that out. That's the view coming in from Dipan. On that note, we're taking a short break. Don't go anywhere, gentlemen. We'll come back to you after this short break and carry forward a discussion on the markets.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.